Welcome to the Industry Experts Panel at PortfolioWealthGlobal.com. My name is Michelle Holliday. Joining us today is Mr. Andrew Maguire. Andrew is an independent London metals trader. He is an expert in gold and silver. Andrew became known as a whistleblower when he presented evidence to the United States federal regulators alleging that fraud had been committed and that prices in gold and silver markets have been manipulated. He has an amazing story to tell. Andrew, welcome to the show. How are you today?
Hey, Michelle, it's great to be with you.
Andrew, for those who do not know you and do not know your background, can you please tell us and give us an overview of why you are known as the whistleblower and what happened? Because this is a fascinating story.
Absolutely. I think when this story started was 2009. And if you remember at that time, everyone said it's impossible that the markets are manipulated. Of course, this was before LIBOR or any of those things where people suddenly woke up to the fact that perhaps markets are manipulated. But I think just if people want to, I know that people want to sometimes have a look at a video clip or something, but I did on the History Channel. It's also on YouTube. There is a program called The Secret World of Gold. It's actually a really interesting. It was done by the Canadian Broadcasting Corporation, and it basically is a great story about gold. But on there, it does. You see the regulators talking about me and about my evidence, and I do walk through a multi-billion-dollar silver raid in sort of not in real time, but I dissect it and how many billions were made and how it was impossible for that not to be a market manipulated event. So basically, that sort of outlines, in video terms, what perhaps what I was doing. But really, what I did was essentially provide 80 examples, and many of them were provided actually ahead of the most of them were provided ahead of the price rigging, where I would say, look, tomorrow in 24 hours, price of gold is going to finish exactly here, and it's always down. And the price of silver is going to finish exactly here. Now, there's well over 80 examples of that, and my lawyers auditably recorded these ahead of me providing this to the CFTC, and then bingo, what would happen is by magic, the price of gold and silver would finish at those levels the next day. Now, you really would think that would have the attention of the regulators, which indeed it did, but there was very little being done. And so what happened was, one day I was sitting in front of the DOJ because we went to the DOJ to say, hey, look, we've given you all this evidence to the CFTC and they're not doing anything. Why are they not doing anything? Now, I was working with one of the commissioners called Bart Chilton there, and I'd say he was very, very helpful, but very frustrated that my evidence wasn't being looked at by the other. It takes out of the 5 commissioners, it takes 3 to vote, and there was constantly a lack of voting by 3 of those commissioners to allow this to proceed. Now, when I sat in front of the DOJ, we made a PowerPoint presentation to them in their offices, and when they looked at this, they sent us out the room for a while, and then came back and then said, "Look, this is incredible. Of course, we're going to look at it." But then one comment was made by the director there, and it got my attention. And they said, or she said, "Well, but what about the economic consequences of this?" And right there, I knew nothing was going to get done. And so really, I suppose, that's probably leads on to other questions I'm sure you might have about manipulation.
Now, Andrew, give us a timeline on this. When did you first start trading in gold and silver? How did you notice the manipulation? During what year? And when did you take it actually to the DOJ?
Oh, right. Took it to the CFTC, and in fact, there's an email trail. Because of my frustration, I published an email trail with the CFTC because they weren't doing anything. And this is before I involved my lawyers. But so these were done in real time, so they're time stamped ahead of times. How embarrassing for CFTC when it's like me saying, look, there's going to be a bank robbery at that ATM on that street corner tomorrow at 3 o'clock. And it happens. So then you say, okay, well, there's going to be another one in 2 days' time at exactly the same time, and no one turns up. And 88 times later, still no one's turning up. So you kind of wonder, what is the issue here? Why is this not being addressed? And I think so. This was 2009 when I first started. That's auditable. We've got an email trail to some of the policemen, as we would call them, in the CFTC. We were working with investigators, and my emails were addressed to them, and they were ahead of time. And I'd say, in fact, I think in one of those emails it said it's going to be 2 days from now, and this is where the price will be. And then it exactly played out that way, and that was silver and gold. We made the presentation to the DOJ in 2011, along with my lawyers who represent me as a whistleblower. I'm accredited as a whistleblower under the Dodd-Frank Act. And really that was one of the problems with that is, of course, I can't give that evidence out for obvious reasons. Now, 2014 was, we presented that evidence all the way to 2014 and continue to help with class action suits and one thing and another. And in fact, the CFTC in January of this year actually put out some of that evidence was acted on in the sense that it was just related to the spoofing element of my evidence, and I think people need to, I'd probably understand what spoofing is, where you're actually putting bids and offers in rapid succession, and you never intend to fill them, but what you do is it influences in the direction of the market. And this is done in collusion with other banks other trading banks who you're working with. So it's a real collusive stuff. And of course, that was ruled by the CFTC. Deutsche Bank was caught doing it. HSBC was doing it. Those orders are on the CFTC website. So, it made it pretty clear that this kind of work was going on. But to take it to the next step of proving manipulation, that's a whole different standard. And obviously, unfortunately, the rules for that standard seem to be, let's just say, they're discretionary, and really nothing was done.
Andrew, this is fascinating. It's just fascinating. You hear about this is happening, but you really never know, who knows this, So you actually know it, witnessed it, could predict it, and knew the whole equation was happening and could prove it. That's just extraordinary. Now, the next question is, if gold manipulation is openly talked about, why is it that the regulators do not seem to be doing more to investigate the situation?
That's a great question too, Michelle, and we've all been scratching our heads over this for a while. But the answer is, and this is the bottom line: the price of gold is officially managed against the US dollar, and people forget this. People forget that actually, unlike any other commodity such as oil or grains, gold and silver are also foreign exchange currency crosses, just like just like looking at the dollar against the euro or the dollar against the yen, there's a pairs trade where you're long one side, you're short the other. So essentially, gold is a part of that 5 trillion a day currency market. And so, very few people appreciate that, and it's amazing that the mainstream media don't really sort of even highlight that issue. But what it tells us is that gold and silver are recognized as currencies. Now, trading in the unregulated, this trades in the unregulated foreign exchange over-the-counter marketplace, primarily based in London. Now, therefore, along with all the other currency pairs that we just talked about, gold is also officially managed along with all these other currency crosses. Now, central planners fully admit to managing, let's say, quote unquote, managing the currency pairs, but they remain silent on their policy of intervening in the FX gold market and the foreign exchange gold market. Well, what we do know, though, Michelle, is that every 2 weeks, central bankers meet in Basel, Switzerland, to agree, amongst other things, a centrally planned currency management plan. Now, the FX gold portion of this management is run by Benoit Gilson. He has a gold trading desk, and he operates the gold trading desk for the Bank of International Settlements, which is, of course, the central bank of all central banks. So every 2 weeks, they meet and discuss, amongst things, where they want the currency crosses to be. Now, so really to answer your questions, regulators are exempt from these central bank activities. Now, however, in this unregulated smoke and mirrors world of currency interventions, just half a dozen market-making LBMA bullion banks, that's the London Bullion Market Association banks, half a dozen of them are privileged to have gold accounts at the Bank of England. And they are obviously afforded the transparency into central bank activities because they have to act as agents for the central bank. Now, undoubtedly, this gives them an insider advantage as to where gold is being intervened in. So really, it answers your question. They get a free pass. When central banks play in the gold currency markets, they get a free pass.
Wow. Wow. Now, on the subject of silver you just mentioned, how many ounces of silver are needed in order to cause a silver market to experience a shakeup in the futures market? And alternatively, how many months do the miners need to keep inventory at bay for the price to reflect the true supply to demand value?
Michelle, just another great question. I think for this one, we have to step back a little. Now, gold and silver COMEX futures do not in any way represent the underlying physical product, in this case, silver. Futures markets should provide a useful, legitimate hedging conduit for producers, refiners, asset managers, etc., etc. However, it's clear that the futures markets have become little more than a casino operation where through the power of position concentration, and where as few as 2 market-making banks can control the supply of a limitless quantity of synthetic silver. Now, we have so many examples of this, but just let's look back 2 weeks ago. I mean, it's always good to give an example. That was the 15th of June, just 2 weeks ago today, and this provides the most recent example of an implausible price-setting action. I think it's going to blow people's minds. Now, I think it's worthy of taking just these 2 minutes to really look at this example that I'm talking about.
Of course.
So, with that in mind, let's look at the action in this tiny silver futures market. We know this is a far smaller market than gold. And I'm just going to look at that 15th of the 15th, Friday the 15th, from the pit open, the COMEX pit open, which occurs at 8:30 a.m. Eastern Standard Time, and the following Monday pit close, which is 1:30 p.m. on the Monday. Now, during these 2 short daily sessions, and you brace yourself, we evidenced over 50,000 tons of the front month July silver contract put on offer and exchanged on no news and into a severe price decline. Now, speaking as a wholesaler, this makes a mockery of the CME-run price-setting mechanism. Now, Michelle, 50,000 tons was almost twice annual global silver production traded in just 2 COMEX sessions. Now, if this was real physical silver, to actually effect delivery of this, it would have logistically required 2,000 fully loaded Brinks trucks stretching 20 kilometers long, and no vaults would have been available to deliver this to. So obviously, this makes a nonsense of the silver markets, but what it's telling us, clearly, this traded bullion does not exist in the real world, and yet with this volume of synthetic supply being directionally dumped into the futures market, a distorted physical price is determined. So, and then into that equation, that there's audible position concentration. And what we're talking about here is just 4 market making bullion banks. And that is evidenced in the published COT report, the Office of the Comptroller report, where we've sometimes evidenced up to 99.8% of all futures, not futures, of all derivative positions are held in the name of one single bank that we're able to influence. Quite clearly, these banks are able, by this power of position concentration, able to influence the direction of a 95% algorithmic driven market. So if you know where the margin positions are and you're holding the book essentially on these margin positions, you know exactly where you need to move a price to break a support level. And by no coincidence, and we're talking about this example, just before this dump that we're talking about of synthetic supply, silver was threatening to break out above very large naked short commercial bets exposed in the options and the derivative markets. And we know they're naked short because over 99.9% of all COMEX positions are never delivered. Now, the employment of insider controlled directional high frequency trading bots, and these are the ones that control the neutral ones, and we know it's a 95% algorithmic driven market, but really many of these are simply they're really agnostic on price, and they're simply looking to take a cent this side, a cent that side, and they don't have direction. However, there are certain directional algorithms which clearly orchestrate all these neutral algorithms. And so this kind of action is embarrassing, you would think. I mean, the sheer volumes of undeliverable synthetic paper silver supplied into the market expose the COMEX paper silver market as a broken mechanism for fairly valuing silver. Yet the regulators, as we've said, do nothing. Now, worse, producers are captive to these same insider bullion banks that finance their operations. So the same broken pricing mechanism is evident for gold. We saw in that same short window something like 2,700 odd tons of gold exchange. Okay, that's pretty close to an entire year of annual production traded in these basic on no news drivers in this very, very tight window that we're describing. So COMEX futures, as we know, are 99.99% undeliverable and are cash settled. The answer to your question is that as long as the COMEX casino can suck in as many non-delivery speculators to wash and rinse, this game will go on. However, there is an answer. And as more and more investors seek a real hedge in physical vaulted form outside of this central bank controlled system, these physical exchanges are sucking out paper market liquidity into the real physical markets. Now, this is important because this means that when the casino operators push prices too low, which we're seeing now, the underlying physical underpinning these undeliverable contracts is sought for physical delivery in the global markets. Now, we know this because we're wholesalers. And as these ounces flow out for physical delivery outside of the casino, this creates a huge unwind of physical market leverage. Now, everyone now understands this game. And as a wholesaler buyer looking to fill client orders at the best price, we've so far been also afforded the luxury of sitting back and just capitalizing upon this predictable insider run game. However, it is the sort of extreme examples we're now witnessing that tell us this game is now vulnerable to an increasingly more liquid physical market. Now, how many real ounces are required to break the paper silver market? Michelle, very few. I don't know where this is going to come from.
Andrew, that is mind-blowing. So what you're saying is that everyone who truly knows the market, such as yourself, knows that they are watching a completely fraudulent activity take place. If you have twice as much silver as exists in the world trade in 2 days, something's obviously wrong.
Yeah, and it doesn't escape. There's competing central banks, of course, We know that China is playing its own game, it's obviously trading its own book. It's not all one-sided anymore. We're seeing other sovereigns coming in and buying and taking advantage of these effects. And now, for example, today, and interesting that we're talking today because it's the end of the month, and the over-the-counter. We talked about the Bank of International Settlements. Well, this is primarily to do with gold, but essentially at 3 p.m. UK time on the end of a month, as of today, the pretty close, we estimate pretty close to $1 trillion worth of gold derivatives are marked to market. Now, you can imagine how important it is for this to be marked at a favorable price. Now, if we saw a price coming in above where the central planners wanted gold to fix on the last day of the month, because it fixes these enormous amount of derivative positions once a month, then obviously we see by no coincidence price groomed to pretty much where we know it's going to end up with. And this is so. What we're saying here is that we know that game. Chinese central bank knows this game. Indian wholesalers know this game.
Wow.
Of course, we sit back and wait for this event to just come to us, and then we buy it. And
it's so enlightening, Andrew, to someone such as myself, and I'm sure to many in our audience, it's just very enlightening to realize this, that you're just watching a game.
Yeah, it is a game. It's a casino. I mean, as we know, in a casino, punters are allowed to win 5% of the time. The house keeps 95%. This is no different. Same game.
So interesting. Now, shifting gears just a little bit into blockchain technology. There are now very simple ways using blockchain tech to truly audit the gold and silver going forward. The more people put their precious metals on this grid, the less paper leverage there will be. What is your perspective on this?
Yep. Again, we have to, because of what we just discussed, what we have to do is de-incentivize investments in high counterparty risk paper and silver gold instruments. And what we need to do is incentivize choosing the real physical bullion, because this way you're exempt from the games. Now, placing any asset class, whether it be a Bitcoin or a gold and silver, into the insider run CME casino, or even the fractional reserve LBMA unallocated gold or silver market, which we just described is the foreign exchange market in the UK, that just simply provides a unit of account. So yes, it does provide a unit of account, the blockchain, for these synthetic trades. But what it doesn't solve is the ability to create synthetic supply at will. Now, we saw that recently with Bitcoin futures as well, where all of a sudden that traded on the CME, and then all of a sudden you got this massive volatility. Now, cryptocurrencies provide a welcome decentralized alternative to the legacy banking system, but critically, they don't solve two of the three elements required to be a sustainable global currency. Now, they do provide a unit of account, but they fail on the two most important elements, which is to provide a store of value, which gold and silver would do, and to be an efficient means of exchange. So, and which of course cryptocurrencies aren't at this point, because there's enormous fees and time lags. Now, what needs to happen to accelerate the dislocation of the paper market from the physical market is to incentivize a whole new investor base looking for a zero counterparty risk store of value, which will drive an upsurge in physical demand. And this will enforce a price discipline on the paper market that we're just talking about. Now, there is a solution, and it's something I'm actually very excited about, because this journey from 2009, where I knew the regulators were going to do nothing, I've been working very, very closely with a range of physical liquidity providers and takers, and we're really working very closely to try and create facilities where people can buy and sell physical gold without going through the legacy system. Now, what I'm excited about, and I want to bring this to the public's attention, many people buy into the purposely spun argument that gold is a barbarous relic. And how many times have you heard someone say, you mine it out of the ground, you buy it, then you bury it? I mean, we hear it time and time again. And this is the first argument you hear whether it's a neighbor or you're sitting on an interview with the mainstream media who try and never seem to want to big up gold. However, by attaching a yield to gold and silver bullion, an investor can weigh up this yield attached to gold and silver against all other asset classes. And by attaching a yield to any asset class, you simply increase the value of that asset. So on that premise, we have something pretty exciting to talk about, because I think this is going to change everything and speed up this process of where we see liquidity flowing out of the paper markets into the physical market. Now, early in the new year, there is a revolutionary one-to-one physically backed gold and silver currency is about to be launched. Now, I'm going to perhaps suggest that the CEO of Kinesis comes and talk to you directly about this on another interview, but it's Kinesis is the name of the currency. Now, there are many reasons I'm excited to see this 6-year project, and this is a project we've been working towards ever since we knew the regulators were not doing anything. And we're really excited about this coming to market. But to name, there's just if I just wanted to name 3 reasons, because we haven't got that long. The 3 reasons that Kinesis not only solves the unit of account problem you just referred to, but it also solves the 2 critical problems other cryptocurrencies fail on, which is to be a store of value, i.e. the lack of volatility because it's geared to a physical value, and to become an efficient medium of exchange. So in other words, we're about to see the remonetizing of gold and silver. Now, this is hugely exciting. It's welcome to see other gold-backed currencies appear, and they come, and I think there's about 60 of them. It does draw attention to the merits of holding physical gold. However, none of these currencies solve the efficient means of exchange. Only by attaching a yield to gold and silver, and this is something that no one's ever attempted before, and silver as well, can this be achieved by incentivizing its use as a payment system. Now, I see Kinesis as the trigger for a revolution in how money transacts. But from the perspective of a seasoned gold and silver investors and traders, Kinesis provides the key to leveling this playing field once and for all. And I see Kinesis not just providing a store of value and a medium of exchange solution that will allow the remonetizing of physical gold and silver. It'll also put an end to the seemingly eternal synthetic gold and silver wash and rinse cycles that we see around once a month and end up at Bank of International Settlements, 4th Friday of the month at 3 p.m. Now, what Kinesis does is put the aggregated power of physical concentration back in the hands of us, the people. And why speculate in paper gold and silver when you can own real physical gold and silver and earn a perpetual multifaceted yield? Now, each of us using Kinesis becomes a solution, and we end this paper sham. And I think, I'll give you the website address so people can make their own minds up. But I encourage everyone to visit the Kinesis.money website and read how you can become part of this solution. The only thing I will caution against is don't read the Kinesis blueprint or white paper just before bed. You will not sleep.
It's that exciting.
It's that exciting.
Oh, man. What a time to be alive with all of these new, fresh innovations, blockchain, AI, cryptocurrencies, the changes in gold and silver, whatnot. Now, yes, please go ahead and give us that specific website that you just mentioned.
Yeah, it's Kinesis.money. And everything there you'll need. You can join a Telegram group. I think there's something like 8 or 10,000 members there. Throw in questions, find out what you want to know, see if it's, question it, look at it, work out the yields. I mean, we're talking 6-8% yields. I mean, essentially, we're starting to get interest from the mainstream press, not because if we were to approach them and say, hey, by the way, we've got a great gold story, you're not going to get it printed. However, if you approach it on the basis, guess what? How about you get, if you could earn a yield on a tier 1 asset and the tier one asset is already determined by the Bank of International Settlements saying gold is a tier one asset. And you can get that yield. It's a tier one asset and it's ethical because if you're LBMA gold, and as much as the LBMA system is highly suspect in the sense of trading paper to physical, each bar is actually KYC'd from a mine to a vault. And so if it's an LBMA bar, which of course all the gold that we're talking about would be, then obviously we know that there's no blood gold involved, that every single ounce that it came from the mine ended up into a vault through the LBMA system. It's ethical. So you've got three elements. You've got a yield on a tier one asset that's ethical. Well, I'd like to find out anywhere where you can get a yield on anything that isn't high risk.
Oh man, and it's so important that it's ethically mined, and our audience is all about what is new, fresh, to stay out ahead of what's actually going to be big.
Yeah.
Now, Andrew, is silver completely demonetized in today's world? Why is it that it seems like gold is a currency, but silver isn't? And will it ever come back?
Yeah, and in a word, Michelle, yeah, and only for the reasons we've just looked at. I mean, silver and gold are a 5,000-year-old currency, and essentially what's happened is they've been hijacked by central planners. And why? Because these currencies compete directly against the worthless fiat alternative that is basically, as we know, pretty much all fiat currencies are basically in a race to zero, competitively trying to race to zero so that you've got an edge over your other guy. And you may have a meeting, G20, G7, whatever it is, and you may agree, oh, look, by the way, we won't devalue our currency. Yeah, right. And we know that's not true. So silver and gold have not gone away after 5,000 years, and they won't ever go away. I think what we can say is $200 trillion worth of global assets have zero intrinsic value. And I'm talking about your cash, your bonds, your shares, paper claims on physical assets such as gold and silver are included. And even 32 trillion of M1 has zero intrinsic value. So yes, everything we just mentioned, except physical gold and silver, has huge utility value, but zero intrinsic value. So I think that's probably the best way to answer that.
Wow. Now, Andrew, was 2010 to 2011 a speculative mania, or do you expect gold to go back to the $1,925 and silver to return to the $49?
I think when we see the physical, what we were just talking about really essentially is the liquidity flow out of the paper markets into the physical markets and the massive arbitrage effect that that's going to create and a backwash into the paper market. So really, we're talking about 1925 gold, 49 silver. Well, yeah, now that was based upon a highly dilutive price too, and we know that the gold market is openly. The Reserve Bank of India in 2010, they wrote a report, and quite clearly in there it said there's 92 ounces of paper gold traded for every ounce in the vault, and that's the Reserve Bank of India. They haven't done it since, but we know that. And we have CPM Group coming out and saying, oh well, so what? 500 to 1 leverage on silver, so what? Well, yes, so what? This means that if everybody came in to take their gold, even if you just accept the 92 to 1, or you accept even 100 to 1 on silver, if everyone came in and said, I want to take delivery, it's just not there. So what is the real price? It's certainly got to be higher than the 1925 price, which was established in a highly synthetic marketplace. And what we're saying is it's a different paradigm now. We're moving into a physically driven marketplace. And yes, we're all sitting back waiting for these games to continue so we can buy gold cheap. But when we realize that game is about to stop and break, then there's going to be a race to get into physical. We're going to go bid only. I don't know what that price is, Michelle. I've been around a long time. I don't know what the price is. It'll settle at a point where somebody's actually willing to sell you their physical gold. When you go into a bid-only marketplace, well, we know that that can be a significantly higher. And we may even get an overshoot and come back a bit, but it's certainly got to be higher than the prices that we saw in 2010 and for gold and silver.
Wow, bid only. That sounds like it could just skyrocket fast.
Yeah, I think if there's no offers to sell, I mean, if you see in any bid-only market, and if we suddenly see there's a race if we as wholesalers, and we all see the central banks of China suddenly saying, "Hang on a minute, this is getting to the point where we need to move in." Someone's going to revalue gold or silver at some point. It's either going to be China or it's going to be the West. Gold and silver are priced far too low. And it's really a question of, at some point, when do these revaluations happen? Well, someone's going to do it, and I think at the point where we see the footprint starting to weaken, which is now we're seeing ludicrous situations where we're seeing that kind of volume of silver that we just described trading. It's become a joke. So obviously we're now saying, well, we're all looking at each other saying, well, who's in first? Because if suddenly everyone comes in on the bid side, we're going to see a big gap up in silver, and it'll be I think silver would be the one that gaps quickly, and it's going to surprise everybody.
Wow, that's really encouraging for silver. Now, Andrew, many predictions for higher gold prices in the past have failed. Many gurus have called for $10,000, $20,000 gold. And on the flip side, others have predicted $400 gold and have brought in tons of material evidence to support their claims, but still they come back empty-handed. Now, reputable economists showing proprietary statistics have called for hyperinflation for years. Why is this happening? Why is all of this doom and gloom continuing? What's happening here?
Yeah, I think just looking at it from the perspective of, I deal with a lot of large institutions, some of the largest global institutions and asset managers, and it's where they're putting their money. I think this is where the power lays, and it's pretty clear that everyone is now of the opinion that central planners have lost control. It's really a series of plate spinning maneuvers. We see Powell coming in, talking down, perhaps where maybe we best not raise the rates as quickly. Then we see the ECB coming in as a 1-2, and then we see a massive price splash. We see this is all centrally coordinated. As I say, these guys all meet at the Bank of International Settlements every 2 weeks and coordinate the plan. Now, I've been in the wholesale business for decades and never seen such a very large move into physical gold and silver. Now, this is a physical gold and silver. I'm not talking about physical, paper gold. We're talking about physical gold and silver vaulted outside the banking system to hedge against the imposed counterparty risk we're all being subjected to. I mean, even our cash, it's not even our cash, but even cash is subject to bail-in legislation or negative interest rates. And so really, this era of privatizing profits and socializing debts every time there's a problem is actually starting to be hedged by some very smart big money. And if you have to play the risk game, you need insurance. And you have insurance for your home, and you hope you never call on it. But we're even seeing people who don't really want to talk about or never been involved in gold or silver buying gold and silver as fire insurance. Because if you've got to trade in a bubble-like marketplace simply to compete with your competitor, I mean, the guy that gets fired is not the guy that lost money. It's the guy that didn't join in with the game. And I think, if everyone loses money, no one gets fired. If you're the only one that didn't invest, you get fired. So, so essentially, so you now need to bring some hedges in. So that's really why we're seeing the largest asset managers starting to move in to physical. But what they're doing is taking that physical, and they're not vaulting it in the US. They're not vaulting it in the UK. They're vaulting it in places like Liechtenstein, Switzerland, Hong Kong, Singapore, places where they're outside the reach of the central planners. So this is interesting.
That's very interesting. Could you expound on that just a little bit, on what their thoughts are and why and how much gold we're talking about that's outside of the central bank's reach?
Yeah, well, I mean, we're talking a lot of these asset managers have obviously not put any of their, even the fraction of their exposure into any safe havens before. But we're seeing that now, and it will only take a tiniest fraction of asset managers doing this. And I think this is another reason why I was talking about the excitement, the reason you that you find it hard to sleep after reading the blueprint for Kinesis is because what this does is bring a fresh asset class to people. What it does is say, as I say, when you attach a yield to any asset class, you increase its value. So all of a sudden they're going, well, hey, if I can earn a yield on gold, I don't care about gold, don't care about silver, but hey, if I can get a yield on something, I'm going to go for it. So what you're seeing is it expand into an area where it's never been before. And you could be talking thousands of tons.
Mm. Now, Andrew, what are your thoughts regarding the gold to silver ratio at this time?
Right. We're talking about the paper-centric market. I'd say even a paper-centric market, 35 to 1 would be a first step, putting silver around about $35 today. 15 to 1 historically would be correct level, but based upon a real physically settled supply demand price. But what is that price? Based upon gold. And again, we're just talking about the gold price and being a synthetic gold price, and that now likely being suddenly finding a bid under that price as people start to move into it for the reasons we just described. And basically what we're talking about is that forces, we're talking about leverage, even accepting what the Reserve Bank of India said about gold, 92 to 1. And you're talking about silver, where CPM Group talked 500 to 1. I mean, what we're talking about here is each time you unwind, somebody who's sitting on an unallocated account, i.e. I own 9 tons of gold as a pension fund, it's in unallocated form. Oh, hold on a minute. If I can actually, why am I holding that in unallocated form? Well, because it's costing more money to vault it. Storage fees, insurance, etc., etc. Okay, so now if you can eliminate that and you can earn a passive yield, and actually it costs you, in fact, it doesn't cost you anything then to store this physical gold. What you're going to do is unwind your unallocated position, which is high counterparty risk reliant on the bank that is holding that paper, into a physical position where you lodge that into a vault in your name that cannot be touched by anyone. You know it's there, auditably it's there. Compliance loves it, and the whole thing is a nice round wheel. So yes, I think what we're going to see is a higher price. So where does that put even 35 to 1 silver? Where does it even put 75 to 1 silver if we're talking on a significantly higher price? And I think we should be looking at silver, and many people are talking about silver at $100. Well, it really would still be cheap at $100 based upon the historical norm of 15 to 1, and it's only the paper market that has distorted and really completely disrupted what has been historically a leverage that was based upon mining, based upon what was being produced, and therefore a value was established on silver based upon effort to mine it out the ground, etc., etc. 15 to 1 was about right. So I'd say $100 silver, it's a no-brainer.
Okay. Now, Andrew, taking this from a different vantage point, if there is a price suppression scheme happening, should not people be happy about this to take advantage of it? You have said that knowing this actually gives us a tremendous advantage. And honestly, I wish that there was a price suppression on all of the things I want to buy. You know what I mean? So taking it from that perspective, what are your thoughts?
Well, and I hate to be one of the people that took advantage of today. I mean, we didn't short anything. I never short gold and silver. It's a dangerous thing to do. Plus, I only want to deal in the physical. But what did we do today? We knew that gold would end up higher than it was earlier in the week. Why? Because as soon as the this Bank of International Settlements options expiry to defend about $1 trillion worth of derivatives that are underwater, would be underwater at a certain price, we knew that would probably end up in the round about the 1255, 1260, 58 level. And that's pretty much where we're heading to after this event. And so what did we do? We all waited. We all waited for this price, and then we get filled. But what was, I think we also pointed out that this game, we're starting to look at each other now and saying, well, okay, so we know it. We're not colluding. We're sitting back and knowing that the big boys are going to take the price to us. So why chase it? There comes a point where we don't have that luxury anymore, and I think that's coming pretty soon. And that's when I think we go bid only.
Wow. Wow. It's just been extraordinary. Andrew, this has been an amazing interview. Please tell everybody about what you're doing right now and how they can follow your work.
Yeah, I think to me, I mean, really, I mean, I could have sat back in 2009 knowing where the price of gold and silver was going to end up. And it's a no-brainer. It's like saying, I know when every horse is going to win every race. That would have been wrong, ethically, morally, and it would have been, yes, I'd be very wealthy, but it would be the wrong sort of wealth. And so I basically, what I'm saying is, look, from my perspective, I want people to go have a look at this new currency, and this currency is this is the people's currency. This is going to change the way everybody thinks of money, where you can actually earn a yield by using your money and actually level this paper market at the same time. To me, that's what I would much rather than people following me personally, that they do that and have a look.
Okay. Andrew, thank you so much for being on this show with your incredibly enlightening information.
Michelle, it's been great to be with you, and what I'd like to do is perhaps introduce you to Tom Coughlin, the CEO of Kinesis, for another interview, and I'm sure he'd be very pleased to come and talk to you. I think it would be really enlightening for, having sort of segued into it, perhaps to, if you ever wish to have him on the show, I'm sure I could organize him getting in touch with you.
Absolutely. We'd be thrilled. We'd be thrilled. Our audience always wants to say, as I mentioned, out ahead of what's about to happen. That's our whole thing.
Okay,
So
well, that's
we're out
great.
ahead of it. We want to know. We want to at least know.
And next time we'll be in a higher bandwidth area, and we'll go video as well.
Absolutely, no problem. I'm excited to do that and excited to have you back. Mr. Andrew Maguire, gold and silver expert, trader, and analyst.